Hi, and welcome to your weekly macro roundup. We talk macro and try to make sense of markets that, today they didn't make any sense at all. So I'm your host, Steve Van Metre, and thanks for joining me today. I know you're eager to know what's going on in the bond market. Don't worry. The crown is in the house, so we're cool. If I seem a little out of sorts today, because I do want to get to the topic of how the Fed prints money without printing. Pretty interesting, right? I just got done recording with Patrick Ceresna and Kevin Metre of the Market Huddle podcast, which will be released tomorrow. Their show is about the background, where someone came from. Well, mine's not the normal way people get in this industry, so maybe you'll find it interesting, and I'll definitely on Monday have a link to the show. On Wednesday, thanks to many of you, I was invited on the Jay Bravo show. Now, if you don't know who Johnny Bravo is, he talks macro, and he's a swing trader. So I was on his show on Wednesday where we actually got into talking about swing trading and different positions and whatnot. And so I'll have a link to his show, hopefully if I remember, in the description below. But thanks to all of you that reached out to him and suggested that he had me on as a guest. I know he said it was a great show, and so hopefully if you're interested in hearing about swing trading and my thoughts on that, we'll be sure to check him out. So let's talk about the Fed and how they print money without printing money. We got to get into the bond auctions the third year that everyone said was terrible, but it's really not that bad after close inspection. And if you're on Twitter and you're not hanging out with all of us talking bonds and macro, be sure to follow me on Twitter. Link to that in the description below. It's really cool to see a number of you who I've met through the show get in there and talk and discuss bonds and macro. And it's a great time, and I want to thank all of you who are participating there. So let's get into what's going on in the bond market and how the Fed does print money without printing money. Because the Fed does need to reinflate the economy somehow, but they can't do it directly. They do not have that tool. So they use quantitative easing, which we've discussed considerable times. It does not create liquidity. In fact, it removes liquidity from the system. So how does something that removes liquidity eventually create liquidity? And how does this all make sense? Well, it's simple. We have been seeing banks accumulate treasuries, but we'll look at the data and we'll talk about why maybe that's a problem. But all of a sudden, we're seeing foreign central banks step up to the plate and buy huge amounts of U.S. Treasury, especially the 10-year this week. And why would they do that? If there's a dollar shortage, why would they commit their precious dollars that they might need to buying bonds? And why did the smart money buy all of these bonds? And why are the commercial banks, at least for the moment, accumulating massive amounts of mortgage-backed securities because they can't keep up with the Fed's $80 billion a month of bond purchases? Why is that leading to liquidity? Because the only thing the Fed can do is lower interest rates. That's what monetary policy does. I mean, they can raise them, but quantitative easing right now leads to lower interest rates. So yields eventually go down. Now, I know this week they went up quite a bit, but the trend is still lower until proven otherwise. And that would be when the Fed stops doing quantitative easing, and they're not. So why does everybody want to stack up? Why are these big players stacking up their bond positions, including, obviously the large commercial banks? Because what if, in a commercial bank standpoint, you could increase your reserves by 10% in a short period of time? What would that free you up with your other money? Well, perhaps to lend. And what if you're a foreign central bank and you could increase your bond price, your treasury holdings by 10% overnight? Well, you could sell some of them to get dollars. And what if you're the smart money who has been sitting on bonds for years? People have been making fun of you, telling you how dumb you are for not being in the equity market. Well, you know also that when bond prices shoot up and you cash in, that you're going to come back and buy risk assets on a lower price point and flood money into the economy. And all that is because when the Fed does their eventual next big round of QE, all these people that are sitting on bonds are going to sell. And they're going to get dollars indirectly from the Fed through the system. And those new dollars are going to be put to work. The commercial banks eventually will use them to lend. The smart money will use them to buy asset prices. And foreign central banks will use them to help try to restore world dollar liquidity. That's the only way the Fed can actually print money without printing money, is increase bond prices by lowering interest rates and get those people that have all these bonds to sell and deploy that cash. Again, it's going to flow through the commercial banking system or through the open markets, one of the two. And that's pretty interesting to me, because everyone keeps saying that, okay, bond prices are going to go down forever now, the interest rates are going to go straight up. And when you think about the process, and I want you to ask yourself if this makes sense to you. So the primary dealers who go to the auctions are going to buy bonds. And then after they buy them, interest rates are going to go up. So the value of the bond's is going to go down. And then they're going to take a loss selling that to the large commercial bank. And then the large commercial bank's going to get their hands on it. And in between the time they have it and the next time they're going to sell it to the Fed at an upcoming QE purchase, interest rates are going to go up and that value is going to drop. Does it really make sense that primary dealers and large commercial banks are going to take losses on this process? No, it doesn't make any sense. Why would the Fed do something that reduced the size of a commercial bank's reserves in the process of doing it? It wouldn't make any sense. Why would a primary dealer want to take a loss? No, they're going to make sure that they make a profit on this exchange. And so are the foreign central banks, and so is the smart money, who all been accumulating bonds. And when you start to see it that way, it makes perfect sense. Why would a securities dealer really engage long-term in a transaction that lost some money? Would a large commercial bank who needs to continuously add to its reserves do something or engage in a program that caused it to reduce its reserves, so it had to buy more? No, they're going to manipulate the system to their favor. And you're not going to see the Fed complain about it, because they understand this is how it works. The Fed's not losing money in this deal. They don't care. So that's how the Fed can print money without printing money. If that doesn't make any sense, well, maybe we'll cover it again Monday when it makes more sense as well. Maybe we'll give another go at it. Let's take a look at the data coming out of the H.8, because it's kind of interesting. Some surprises and some not so surprises. Well, one, we see securities and bank credit jump by, it looks like $26 billion. Most of that is coming out of mortgage-backed securities. So big increase in mortgage-backed securities. Meanwhile, Treasury securities fell by, looks like, $15 billion. Now, why is that happening? So this is potential surprise. All of a sudden, we're seeing banks losing or shedding some of their Treasury securities. Well, one, we didn't get that breakout in price, so that's a possibility. Another thought is that QE is just too much. There's not enough supply of Treasury sitting on the market for banks to get what they need. So how do you get new supply? Right? If you're trying to get a new supply of something, there's two ways you can accomplish. One, you can move prices higher, and people will sell as prices go down, as prices rise, who want to capitalize on their gain. Or you make prices go down by driving yields up, by selling near that peak and taking advantage of all the people who believe inflation is coming and want to sell more bonds. Seems to be that I have a hunch that that's how it's playing out, because the banks, look, they're just stacking up on mortgage-backed securities at the tune of about $24 billion. So they're adding bonds there, and in other securities, let's see, no real change there. So they're definitely really working on increasing their holdings here of mortgage-backed securities, but they're losing out on, here's mortgage-backed securities here, losing on their Treasury securities. I'm just wondering how long this will hang on, because we do know banks need Treasuries, and they want Treasury bills. And what did we do this week? The U.S. Treasury had a refunding auction. And what a refunding auction is, or part of the auction was refunding, where they let T-bills, short-term debt, roll off, and they refinance at a long-term rate. And T-bills are really what the banks really want, high-quality collateral. So it's kind of interesting to see what's going on here and how that will play out. I'm kind of just guessing that the banks kind of let this fall off. And you look at where the week ending August 5th is, you see the bond prices start to fall, and that brought out the sellers. Now, loans and leases and bank credit fell almost by $9 billion. No real surprise there. Commercial and industrial loans took a big drop of about $7 billion. Real estate loans up $1 billion. No real change. What surprises me is someone actually lent out in commercial real estate. They must be a brave soul of $3 billion. Commercial loans down $2 billion, mostly due to, or entirely due to credit cards. Everything else is pretty flat. So we're not seeing any other growth in the consumer space, but a contraction in credit card lending. Let's go to the PowerPoints and dig in a little deeper here and see what we can find. Now the M2 is starting to roll over, and I pointed out that this was going to happen once those extra checks stop coming in. So we see the 12-month rate of change is falling, but look at the 3-month rate of change. I mean, they're all falling, but 3-month rate of change is now down to 2.47. I've said this is going to turn negative at some point. Now let's go look at the M2. And let's dig into it. We can go down here to the H.6 money measures because I want you to see what's going on. And savings deposits are down. Now, does that make sense? Yes, it should, because without that extra money coming in on unemployment benefits, consumers now have to backfill their spending from their savings. So I expect this to fall because we now know Congress is out till I think the 8th of next month or something like that. And don't worry, they're not going to walk in the door and sign a bill and be done and checks are going to fly out. So we should expect to see this continue to fall. And then at some point next month, loans start coming out of deferment. So this is very interesting that we see savings drop. We're seeing money leave money market funds as investors crowd in to equities at the peak. The only thing that I noticed offhand that was rising was other checkable deposits at commercial banks rose slightly. But the big story here is savings deposits are headed lower. Oh, I have my line marker over that one. I meant right here from 11,424 billion down to 11.28. So big drop on that. All right, let's go back to the slides. Where are we here? Onto the monetary base, it's up to 4.751 trillion. The 12-month rate of change is still falling. I expect that to turn around. You can't see it here, but let's go look at a chart of the monetary base, and we'll zoom in. There it is. It's up a little bit, down from last week, or last 2 weeks, but it's trending higher. And this is important because I mentioned at some point what would happen. The M2 would start to fall and the monetary base would rise. And what does that tell us for the money multiplier? Well, hopefully you know the answer. It's starting to roll over. Now you can't see it here, but it fell down slightly to 3.84%. Let's go back to the Fred database. And here we see the, I know why I got rid of a chart I didn't mean to get rid of, but here we can see this money multiplier just starting to roll over. So there you go. I know some of you said these charts are hard to see. If somebody knows how to fix that, I'm just doing a screen capture, please send me a message, email me, or get a hold of me on Facebook or LinkedIn or Twitter. I don't know what the solution is. So if you're a technology person who knows how to make these images look sharper, I'm all ears. I'd be happy to help. I'd be happy to have the help. Now let's look at this from a CPI perspective. And what we see is everyone's talking about how the consumer price index is headed higher. Well, look, if it follows the money multiplier, and it does pretty well, what that tells you is the money multiplier should continue to head lower. And I want you to think about it, because what are we going to see in the weeks to come? We're going to see the M2 go down, and we're going to see the monetary base go up due to QE. That tells us already from a macro perspective which way consumer prices are headed. They're headed lower, and that is usually means so are interest rates. So that tells you that there's no inflation coming, despite what the market thinks. All right, back to the PowerPoints. How about real estate loan growth flat at 3.7% despite record low interest rates? Record low interest rates, and despite all the news about how the housing market's booming, is not creating enough lending demand. The rolling 3-month rate of change is hovering above zero. It's sitting at 0.2%, I should say, and falling. The 6-month rate of change rose a little bit. 6 months can fluctuate time to time, but the 3-month rate of change is telling us no growth there. How about commercial industrial lending? It continues to head lower. Look at the 3-month rate of change down to 8.3%. minus 8.37% and falling again. If you do not have lending growth, you do not have higher interest rates. They cannot go together. So people right now that are betting and pushing rates higher by selling bonds or shorting the bond market, all that will cause is a greater contraction in lending that will ultimately lead to higher or lower interest rates. Yeah. So any move higher in interest rates is transitory. It has to be transitory because we're not seeing a corresponding move higher in lending growth. How about loans and leases? All bank credit down to 6.85% from a year ago. 3-month rate of change is minus 297. Wait for real estate to follow that down. And with all that extra unemployment money going away, be curious to see if the real estate market continues to hum along. And credit card growth rate, this should say down to 8.59% as it continues to slide. So again, when you see lending contract or flatline in a debt-based economy, it starts to tell you that the economy is contracting or static. Now, in this case, we're seeing more contraction than we are seeing flatline. So it tells you the economy is shrinking, and the economy shrinking, again, means lower interest rates. And what does it mean for asset prices ultimately? Yep, you got it. You got to be bearish on asset prices because that's how a debt-based monetary system works. Let's go take a look at the auction, the 30-year auction, because everyone's making a big deal about it, and I don't think it's all that bad. And I want to show you why I think there is something to this view that this bond prices needed to fall to get money, to get bond prices down, because the big players were not ready for that breakout. The banks were not ready for it. So here you see $26 billion in total amount auctioned off. Indirect bidders, foreign bidders, they were pretty much 100% of what they were offered. Bid was accepted. Direct bidders or domestic bidders, not all of theirs was taken. But look at this. Primary dealers bid over $34 billion. And how about indirect bidders? Just around 16. So you see primary dealers were bidding double what those foreign bidders were doing. Why? Because the dealers need money. See, does this start to make sense? I think the dealers really need money. And I did the math on this. If you look at quantitative easing, there's 19 days a month the Fed does QE. And I think we talked about this the other day, but let's go over it again. There's 19 months they do QE. And I got to get my calculator up for some of this. Out of those 19 days, there's a 10-day rolling period and a 9-day rolling schedule, 10-day rolling schedule and 9-day rolling schedule. So you get the 10-day, then the 9-day, then the 10-day, then the 9-day, and they roll it over and over. In those 19 days, there are 6 days where the Fed purchases 30-year bonds, and they're all $1.75 billion. So if we take 1.75 and multiply it by 6, there's $10.5 billion of purchase of long bond purchases. It does not include the 20-year. It's all 30-year long bonds. Now, if we assume right here that all of this taken by the primary dealers was a $7.354 billion, is eventually flipped to the banks who then sell it to the Fed. So let's go and subtract, and I'll round up to 7.4, means the primary dealers in relation to the commercial banks are short $3.1 billion over the next calendar days between auction to auction of where the Fed's going to buy $10.5 billion of long-term treasury bonds, and the primary dealers have 7.4. They need 3.1. Now, where are they going to get the 3.1 from? The market, right? So if the banks are going to the dealers and say, look, we need some more bonds, we need some more 30 years, how do the dealers get? Well, they got to go to the market. How do you get people to give up their positions? You can either raise prices or lower prices. And if they lower prices, then it creates more selling than higher prices, which would be probably preferable right now to the banks who would like to accumulate some more of these to sell them at a higher price. It starts to make sense why we saw bond prices fall, and no one seemed to step in the way to do it. I also want to point out that the other reason is you'll notice at the 10-year auction, which was heavily taken, I don't have the PDF pulled up, in the 30-year auction, foreign bidders took a lot of money. And when did we see a lot of the drop in bond prices recently? In overnight market. So they were putting their bids in, right? And then going like, oh, well, Guess I don't need to prop up the market here because I want prices to fall going into that auction so I can get a better deal. And so if this theory plays out, at some point we should see a bottom in bond prices pretty soon here. And then we should see them rise because as the dealer is flipping them to the Fed, or not to the Fed, to the banks, who are then in turn flipping them to the Fed, they need to see the prices go higher than they were, at least at the auction. Does this kind of make sense to you? Because it makes sense to me. Now, maybe I may not be communicating it very well today because, again, it's really hot here, and I usually have a period where I can collect my thoughts before the show, but because of Market Huddle only does the recordings at 1 p.m. Pacific on Fridays, I had to delay the recording. Let's go take a look at the charts, because I know that is really important to many of you, as I think they are as well. And perhaps while we're doing this, I will adorn the Bond King crown because, well, we need that for a little bit of good luck. Okay, here we are on the 30-year, and I keep alt-tabbing to the wrong screen. There we go. And now, all of a sudden, what did we see all over Twitter? Aha, it broke up, and now this thing's going to the moon. It broke its trend line, and all hail high interest rates because, look, somehow if I draw this line inaccurately, you can see, oh, it broke a trend line. Yep, it broke a trend line. That's what everyone's excited about. Now bond prices are finally going up forever. Technically, the trend line would be somewhere up here, but I saw people drawing trend lines. We'll delete that for a moment. Look, the quantitative easing causes lower interest rates. That is the whole point of quantitative easing. And you can see it because we've talked about that tomato soup can analogy where they're taking inventory off. And I had an example on Twitter, and the way I refer to it is it's like a corporate share buyback program. So when corporations buy their shares back, where they reduce the float, and as long as there's demand for the stock, it causes stock prices to rise. Well, what is the Fed doing? They're reducing the supply of treasuries on the market. But guess what? Everybody thinks, oh, that means they're worthless. It doesn't make sense. If you reduce the supply for something and there is demand, and there is demand for treasuries, then bond prices go up. I mean, it seems to be pretty simple, but the market participants drove yields up, sell, sell, sell. Now, I think the dealers were happy about this and were hoping this would happen. And my expectation is at some point in here, this will roll over because we're at a critical point of support right now. And we'll get back to that football analogy because some of you mentioned on Twitter that was really cool. So what did we see in the week ending the 5th, which is on the Friday the 7th? So right here, we saw banks shedding at the top. Now, this is interesting that they were up here holding that resistance line. So there's some you got to look in here and try to understand why would banks want to keep this thing from breaking out? Again, maybe they wanted more supply before it took off. So the banks potentially putting downward pressure on bond prices by selling, and all of a sudden there's a turnover here, and the Treasury bears take over on offense. They drive the ball, big play across the 25-yard line. Now they're at the 35. They're driving down here, the 30-yard line. They're driving down. This is the 30, this dotted line. They're driving down. They're at the 40. They're pushing because here's the 50-yard line. Here's the 40-yard line of the Treasury bulls. And in the past, when we see it get down here, it didn't take too much effort before it waterfalled all the way down. Now, we already saw a waterfall. Normally in charting, when you start to see a waterfall and you get some volume with it, it tells you you're getting close to the end. So when I kind of saw this, and I noticed like, look, and I saw volume spiking. It's telling you someone's coming in here and eating up the supply. That's what it's telling me. That's how you read the volume. Sellers are coming in, and then buyers are saying, hey, finally, this is the price I wanted. So we're stuck here at the 40. Now, the problem is it's been sticky here for a while. The defense of the Treasury bulls has been playing pretty strong here. If they can get a turnover and drive prices back up, then you have what starts to look as like a cup and handle pattern. Now, let me go over to my browser window, and let's show you how to look up charting patterns. So we'll do cup and handle. And let me switch over. Oh, I thought you were looking at the Bond King's got his crown, so you know things are going to be good now. Cup and handle pattern. and you go to Google Images and you find a lot of cool stuff. Now you try to find one, we'll try to find one we can look at here, and I think this one we might be able to make big enough. Full screen, view image. Okay, and it's pretty big. Hopefully you can see it. And so what is a cup in handle pattern? Well, you have prices drive up into resistance. And then the big players, they want to accumulate more, so they start driving prices back down. They get people to start selling, and they start accumulating all of those shares, and they drive it right back up to resistance. And before they break it out, they sense that there's still an opportunity to accumulate more positions. And so they will sell down out of this peak and get other people who are very bearish to sell down. They will start building up and accumulating those shares, and it forms what looks like a handle. So you see kind of like a teacup. And then once they've gotten all of that inventory, all the supply, then the bulls push it up and it breaks out past those two peaks. So that to me is pretty interesting because, as someone pointed out on Twitter, I'm not going to use his name, he said it kind of looks like a chalice because you've got a handle on one side and a handle forming on another. So it would really be interesting to see if into next week this comes to a stop. Now, we can also go look at what the Fed's up to, and we can go to New York. Where's my macro? New York Fed. Here we go. And under monetary policy implementation, Treasury securities, Treasury operation schedule, you've got the latest release today. On the 14th, they purchased $12.825 billion of 0 to 2.25 coupon, which was all notes. They're not purchasing bills. These are all notes. And then on Monday, they're back with the long bond. So it tells me that at some point, these prices need to go back up because the dealers just bought all these long bonds at a slightly higher price. And then looking at here, we've got another long bond and another long bond. This is the 10-day schedule. 1, 2, 3, 4, 5, 6, 7, 8, or 9. 1, 2, 3, 4, 5, 6, 7, 8, 9. There's a like I said, a rotating 9 and 10-day schedule. So you've got 3 long bond purchases coming up, and that should be pretty helpful. And then in the middle of this, you've got a 7 to 20, which is going to pull 10 and 20-year notes out of that auction as well. All that to say, if we get a cup and handle pattern, it's massively bullish for bond prices, because what that does is it starts to pull all these people who are short. It pretty much what it does is it tries to get every last person who is bearish on whatever chart you're looking at to exit their position. It's pretty clear that the sellers still had some desire to sell, because you don't normally see this kind of movement if people aren't that or don't have much inventory left to sell or desire to sell. And notice how the volume picked up here, and down here, and it's starting to tail off on today. So be really curious into next week. We start to see this turn around. You could see this move, a matter of weeks, and break out, and there's your super big move. Let's go and take a look at the dollar. Where are we doing on time? Let's keep this one to about 30 minutes if I can. The dollar is forming a bottom, and again, everybody in the equity market should be super worried about this, because when you look at the dollar and overlay the S&P 500, you see recently the dollar is explaining all the rise in the equity market. And if you start to see a reversal in that, maybe this will help make it a little easier, change the color, then all of a sudden that puts downward pressure on equity prices. We already know that when stocks fall, bond prices tend to rise. And we also know that the dollar tends to follow, or dollar is likely to follow bond prices up, because who's buying? The Fed. So does much of this make sense to me? It absolutely does. And that to me would be bearish on gold mining and gold stocks. So we see potentially GDX, a top forming here. How about on gold? Potential top forming here. I know everyone thinks gold goes to the roof. Don't think so. How about on emerging markets? It's getting kind of near its trend line. Potential could be some risk to break down there. How about energy stocks? They got back above their trend line today, and they're hanging out there on symbol XLE. There's a lot of bad things going on in the energy market. A lot of the large companies are shedding employees, shedding costs as quickly as possible. It tells you they're not optimistic about what's going on there. I want to look at ExxonMobil, the largest position in XLE. Where is it? There it is. See, it's now back to the support level at 42. If it can't hold here, now it's back to its lows around 30, 32 a share. Not very pretty picture for the oil market, but the key now is, can we get a handle pattern here on TLT with the Fed buying? And will the commercial banks come back in here? And we'll see in the data in the weeks to come. Did they start buying down in here? If it did, it really validates kind of my thesis and how this all plays out. So hopefully you enjoyed the show today. If you're new, or even if you're not new, do me a favor, give me a like. We love those. Comment. I know I've been delinquent in the comments. I'll get into them. And if you're new, be sure to subscribe so my wife can have fun and make new props. Anyways, I appreciate all of you being here, and I'll look forward to seeing you on Monday, where we'll see. Remember, you can check that Hedgeopia website Saturday morning and see, did the speculators get even deeper into their already record deep short positions on 30-year Treasury bond futures? I'm really curious to find out. We'll talk about that on Monday. Have a great weekend. Bye now. The content of this video is provided as education information only. It would also be helpful if I had my PowerPoint slide up so compliance would smile. There we go. Is not intended to provide investment or other advice. It chose not to be construed as a recommendation or solicitation by or selling security, financial instrument, or participate in any particular trading strategy. This video was prepared by Steve Van Metre. Personal capacity opinions expressed in this video that do not reflect the view of Alice Financial Advisors Inc. or Steve Van Metre Financial.